The last session, we have started our discussions on measurement. Measurement, we have completed credit risk measurement, the basics about the standardized calculation and IRB foundation approach, regulatory capital calculation and expected loss calculation. After that, we move to market risk measurement. Under market risk measurement, we have discussed the three methods. The major methods which we follow to measure market risk is sensitivity analysis, volatility, and downside potential. Under sensitivity, we discussed about the two approaches, two types of risk which we are measuring for the purpose of maintenance of capital for market risk. That is, under standardized approach, general market risk and specific market risk. Under general market risk, we discussed about the calculation techniques. Under general market risk, we follow standardized duration approach as well as standardized maturity approach. Then we calculate this market risk under general market risk, under duration approach, that is the sensitivity analysis. Under duration approach, we follow the modified duration calculation for the purpose of arriving at the general market risk capital. So, after calculation of this general market risk under duration approach, we move to what you call maturity approach, standardized maturity approach. There we calculate horizontal disallowance and vertical disallowance based on the residual maturity of each instrument or investments. Then we add these two things together and keep capital for market risk. So, as a recap, we will discuss in 2-3 minutes what we have discussed, the calculation which we have done in the last session. The first one is to calculate market risk. Market risk. Market risk capital calculation. Market risk capital. What is the market risk capital calculation formula? Just a recap. MRC, market risk capital, is equal to, what is the formula for market risk capital? Is MOD, modified duration into value of security into percentage change in yield. So, this is the formula which we have learned yesterday in the last session, MRC. So, we use this formula, modified duration, value of security, percentage change in yield. So, we use modified duration under modified duration. Modified duration calculation, there are 5 steps we discussed. The first step is, you remember the chart which we have discussed in the last session. That is the first period, time period. That is 1, 2, 3, 4, 5 like that. Then the future cash flows. So, what are the 5 steps? First one is to reach the modified duration calculation. The 5 steps is present value of future cash flow. That is the first step. Then we need to find out the time weighted cash flow. Then we need to calculate MAC duration. Then modified duration, then change in bond price. That is the sensitivity, duration analysis. That is the duration, how sensitive is the investment. So, these are all the 5 steps to reach this MOD calculation or the sensitivity analysis or the capital calculation for market risk. So, first step is the time period, that chart you remember, that table which we have discussed in the last session, and then the future cash flow, FCV, future cash flow or future value. Then we discussed about this 40 rupee example like that, all the 5 years we got this one. So, 1000 rupee bond price, at the end of that 1000 rupees we got this 1040 like that. This is the second step. Then we move to the present value of this future cash flow. What was the formula which we used? Present value of future cash flow is equal to FV divided by 1 plus R to the power T. So this is the formula which we used. Using that, the 40 divided by 1.045, that is the 4.5 percentage market rate we discussed in the last case study. 40.1405 into 1, that is the time period. Here in 2 times, here 3 times, here 4 times, here 5 times. So we got a total. So that is the present value of it. This is the third step. So you using this formula, we calculated the present value of future cash flow. So we got now the present value of future cash flow. Now we need what? Time weighted. Present value of future cash flow, we got it. Now we need time weighted cash flow. So here in the next table, time weighted cash flow. Time weighted cash flow. For time weighted cash flow, this PV. Suppose if you got the last example, we got some amount like that, 35, something like that. So into time period. So if it is, this is A into 1 is that's the 1 is the time period. Then A into 2, A into 3, A into 4, A into 5. This is the time weighted cash flow. Time weighted cash flow. So PV into time weighted cash flow is nothing but present value. That is the present value is this one into time period. So you got a total. So this is the total time weighted cash flow. This 2 is over. One we got, this one A, then this one B. This also we got. Okay, this one. Now what you need? Now we need MAC duration. That is the next step, MAC duration. So MAC duration, what is the formula? MAC duration formula is total time weighted cash flow divided by total present value. You remember the last session, sorry, we discussed this one. Time weighted cash flow divided by total PV A. That is B divided by A. This one we got. So MAC duration. We got the answer in the last case study. We got the answer as 4.62, something like that. That is in years. So that means this total, B total divided by A. That is time weighted cash flow divided by present value of total cash flow. This will give you the MAC duration here. So this is the next step. In one table we are seeing this table, all the formulas should come to your mind. So you remember all the formula and the steps. How to reach MOD calculation. Now we reach MAC duration. We got the MAC duration. This is also done. Present value is done. Time weighted cash flow is done. Then MAC duration is done. After MAC duration, we move to modified duration. Modified duration. What is the formula for modified duration? Modified duration is equal to MAC duration that we found out. MAC duration, here you got it. MAC duration divided by 1 plus R. That is the market rate or yield rate divided by K. K is the compounding frequency. MAC duration divided by 1 plus R divided by K. R1 plus MR or OER or whatever it is. R, MR, OER, so many things we use the terms. So that is the formula which we use. So for MAC duration, you find out the MAC duration, we got this one, MAC duration 4.62 divided by 1.045 will give you the 4.4 or something like that we got last time. Is it? So this is the sensitivity. This is the modified duration. For a percentage change, for this much percentage change in yield rate, this yield rate change, this is the sensitivity in number. This is in number, this is in year, this is in number. So this is the percentage terms. In percentage terms, modified duration will tell you how sensitive is your investment. This is the modified duration of this particular So 1000 rupees bond, we were talking about the 1000 rupees bond. This 1000 rupees bond, future cash flow every year 40, 40, 40, 40 like that we are getting. In the 5th year, the bond matured and we got 1040. This is the total future cash flow. Present value, we use the cash flow discounting method, FV divided by 1 plus R to the power T. So that method we used it. So then calculated this present value of future cash flow, then the time weighted cash flow, then the MAC duration. Now we got the modified duration. So modified duration also we got. Done. Now the percentage change in bond price. This is what we are interested in. Change in bond price. So this is the next step. Change in bond price. Change in this uppercase delta denotes change. Change in BP, bond price. What is the formula for change in bond price? Change in bond price is, what is the formula? You remember last session we done a case study also. Minus MOD into change in yield. Change in yield. So change in yield. This change in yield, suppose the question in the case study they say that the market rate has increased by 2%. So change in yield will be 2%. 2%. So minus MOD into 2%. And find out the minus MOD is 4.5. 4.5 into 2%, 0.02. Okay. So you will get what? The change in bond price. For 1000 change in bond price, we got 82.4 in the last case study. 82.40 paise. 82 rupees 40 paise is the change. 8.84%. For 100 rupee, 8 rupee 84. For 1000 rupees, 88 rupees 40 paise is the change. Minus MOD into percentage change in yield. Change in yield. So we got for 1000 rupees, this has come down because the market rate has increased. So we discussed that whenever the market rate increases, the bond price will come down. That is the bond price rule. So these are all the steps which we use to calculate MAC duration and modified duration and percentage change in yield. So this is all these formula, just you by heart the formulas and the steps. In one table, you should be able to know. In case study, so many questions may come from this side. Sometimes they will ask you to calculate present value of future cash flow up to this step. Here, up to this one. So you will use this formula, FB is equal to 1 plus R divided by 1 plus to the power T. Use the formula, apply the cash discounting method formula, find out the present value. Sometimes they will ask you to time weighted cash flow, present value into time period, time weighted. Sometimes they will again move forward to find out the MAC duration. MAC duration, total time weighted cash flow divided by total PV. These two steps. Again they may move to modified duration. So 5 marks possibility chance is there to score 5 marks from this single case study. 5 marks you can easily score, provided you should have the knowledge of the concept as well as the formulas also. You have to by heart the formula, apply those figures into this formula and get the answer. So if you are able to remember this chart, it will be easy for you to move further. So the second important calculation method which we discuss is standard deviation. Standard deviation. So what is the formula for standard deviation? Is equal to square root of average sum of square of deviation. This is the formula for standard deviation. This average sum of square of deviation is called variance. Symbol. So standard deviation is equal to square root of variance. Variance is this one, average sum of this variation. So there Like MAC duration, modified duration chart, we prepared one chart, and you remember the example of share price movement which we used. The last table you remember, the first table time period again, time, that is the month, first month, second month, third month, fourth month, fifth month. Then the month January, February, March, April, May, like that. This is the total column. Hope you remember the case study which we have made last time. So like that the chart we prepare. Then we move the share price. Share price. Time period, month, share price. 100, then 110 next month, maybe 90, then again 110 again 80. So like that the movement. Then we got the total here. Total. Then what is the next step is average. That average is called mean. Mean. That is the 500 is the, if 500, what you call, okay, 580, 120. Okay, 500 is the total, means 500 divided by 5 will give you the, what you call, okay, suppose 114 is the, what is the, 500 is the total divided by 4, 5, oh, sorry, 5. Okay, 500 divided by 5, sorry. So, 490. 490 is the total. 490 divided by 4. Divided by 5 is the average. So, 98 is the average. 98 is the average. Here, what is the mean? 98 is the average. Mean. So, what is the difference between the last example? We got 114 like that. So, we use the same example. 114 is the average. Then the difference between mean and, what mean is the average, mean and the share price, original share price, that is the deviation. Deviation. Deviation is equal to mean, difference between mean and original share price, original price, OP, mean and original price. Here if it is 100, 114 is the mean, 100 is the share price, the deviation is 14 here. So like that, what are all the deviation here? Then the next column is square of deviation, square of deviation. So if 14 is the, 14 is into 14, the square of deviation, 14 into 14, 196, like that. Here you find out all the square of deviation for all these 5 months, then you got the total here. So total, this is the total, square of deviation. Then what is the average sum of square of deviation? Average sum of square of deviation. What is the formula for average sum? We use n minus 1 to have a better clarity, better picture, a constant picture. We use this total square of deviation divided by n minus 1. That means here if the total is 5,000, if the total is 5,000, 5,000 divided by n minus 1, n is 5, here 5 months, n is 5, 5 minus 1, 4. So, 5,000 divided by 4. So 5,000 divided by 4, 1250 is the average sum of square of deviation. Average sum of square of deviation, 1250. 1250 is the average sum of square of deviation. Then what is the formula for standard deviation? That is the last step. So we got average sum of square of deviation. It is called a variance. So what is the standard deviation formula? The next one is find out the standard deviation. The formula is square root of this V. That is 1250, if that is the total, square root of 1250. So 1250 square root. 1250 square root is 35.35 is the square root of average sum of square of deviation. These are all the 5 steps. So why I took again a repeated class today means this session also, this is most important. This is the most important session, the mass scoring session, which will take you from 49 to pass mark. So if you fail in the sum, because so many steps are here in these two calculations, MAC duration, modified duration and standard deviation. So simple statistics, simple formula, just you remember this one. So you will score for some minimum 5 marks in the examination. That will take you to the pass mark percentage. That's why repeatedly I am taking this as a recap in today this current session also. So the 5 steps, remember: time period, then the month, then the share price, then the mean. Mean is the average. So then the deviation. Deviation is the difference between these two, mean and share price. Then the square of deviation, just you multiply with the same amount, square of deviation. So then average, this one you take the average. Average means total divided by n minus 1. If 5 is the number of months, minus 1, 4, divided by 4. You will get the variance. Square root of variance, you will get the standard deviation. So this standard deviation means this 100 rupee face value share may come down by 35 or can go up by 35. That is the meaning of standard deviation. So these are all the steps you need to remember, which will help you in your numericals as well as case studies. So now yesterday we in the last session we discussed about the volatility, 1 day volatility. This is the 30 days, the 5 months volatility, monthly volatility which we captured. Every month we got it, we averaged it, we found out the mean, then square of deviation and all, we got the standard deviation of a monthly. So what standard deviation for monthly variance is there, deviation is there, daily variance is there, monthly variance is there, weekly variance is there, quarterly is there, 5 days, 6 days, 10 days, 64 days, like that. So many days variability the questions may come. So what is the formula to find out the variability? X day we discussed in the last session, we discussed the variability also. X days variability, X days variability or T days variability. X days or T days. Sometimes they may ask T days. T is the time period. X is also time. T days variability. Variability is equal to daily variability. Like that, the last one 35 rupees we found out for 30 days variability. Like daily variability, which will be given in the case study as in the numerical, into square root of this T. So if 64 days variability, 64 days variability, find out in the question they may ask you if the daily variability is 1.5. What is the 64 days variability? The answer is 64 days variability is equal to, the formula is daily variability. Suppose in the question if it is given as 1.5 into square root of T. What is T? Square root of 64. So 1.5 into 64, 8. Square root of 64 is 8. This is the answer. So that is the answer. 5 into 8. 12. Isn't it? Use the calculator. 1.5 into 8, 12. So 12 is the 64 days variability. 64 days variability. Like that, anyway. This is the first example which we discussed. Now we move on to the next scenario. 64 days volatility is 12 given in the question. Find out daily volatility. Now in the other way around. So you are in the first example we found that the 64 days they have given daily volatility. Now they are asking for find out daily volatility. Simple, you know the formula. It is very easy to understand now. So answer is 64 days volatility, that is 12. It is given 64 days volatility, that is 12, is equal to daily volatility, that is D into T, square root of T. What is square root of D? 64. 64 is the square root of 64 is the volatility. 64 days volatility in the question it is given is 12. So 12 is equal to D into square root of T. Then what is D? D is equal to 12 divided by 8, simple arithmetics. 1.5. In the first question we discussed about the 64 days daily find out 64 days volatility if the daily volatility was 1.5. Now the other way around, now they are asking for find out 64 daily volatility if the 64 days volatility is 2. So 64 days volatility is 12, means 12 is equal to D, daily volatility into T. Then what is D? D is equal to 64 days volatility, that is 12 divided by square root of 64, that is 8. 12 minus divided by 8 will give you 1.5 is the daily. So like that, so many questions may come. So that is the another example of daily volatility, 64 days volatility, X days volatility, like that. So you can expect some questions from here. Globally, trading takes place 5 days a week, 252 days a year, weeks 5 days, month 21 days, fortnight 10 days, etc., which will be given in the question. So it is not 364, 365 like this by calendar days. It will be based on the working days globally. So what are all the days in which the trading takes place? Accordingly, they classify the working days. Sometimes in the question, they will be given you treat this, the year has 252 working days. Then if you are asked to find out the yearly volatility, use this 252 days calculation, like that. The monthly, sometimes the monthly, if there is no mention about the number of days, just use the calendar days, 30. Otherwise, you find out if it is asked in the question, accordingly you have to move on. Volatility, first method is basis point. Now we are moving to the basis point value, that is the basis point value BPV. This is the another way of calculation of sensitivity and volatility analysis. Sensitivity we discussed in the sensitivity, and that is the duration. Now we are moving to volatility. So how to find out the volatility? So how volatile is your investment? For 1%, not 1%, for 1 basis point. 1 basis point, how much will be your movement in your investment value? That is what the BPV calculation tells. Volatility, first method is BPV. BPV is a method to measure interest rate risk. This is also one question which you can expect in MCQ. BPV is a method to measure what? Interest rate risk. So BPV will give you how much is your risk with regard to interest. That is to assess due to certain change in interest rate what will be the loss to happen. So this will tell you the probability of loss which may come when the scenario changes with regard to the interest rate. So what will be the risk involved? So this BPV calculation will tell you. BPV is the change in value of an investment due to 1 basis point change. That is 1 basis point is what? 1 by 100. That is 0.01%. Simple. So 0.1%. So 10 basis point is 0.1 into 10, 1.1% change in market yield. So what the basis point say? Basis point means for 1 basis point. That is 0.01%. How much will be the change? For 0.01%, that is 1 basis point, what will be the change in market yield? So that is what the BPV will give you. BPV tells how much money your position will gain or lose for a 0.01%. That means 1 BPS, 1 basis point. 1 basis point. Movement in the yield. Market rate goes up means investor incur loss. Market rate comes down, investor gains for investment portfolio. That you know. BPV of a bond is higher means higher is the risk associated with it. So BPV, that is what more important. This you please note that BPV of a bond is higher. So whenever in the question, sometimes the question may come like this. So BPV of higher is A, B, C, D. Investment A is this one, A, B is this one. Which one has the higher risk, like that. So this is the one which you have to remember. BPV of a bond is higher means higher is the risk associated. So an investment which has a higher BPV has a higher risk. This is more important. Just you remember this one, more important. So 5 investments is given to you. So you will be asked to find out which one has higher risk. So higher risk is BPV of a bond with higher means higher is the risk associated. What is the formula for BPV? Change in price divided by change in market rate. So the price divided by market rate. Both are changes. Change in price divided by change in market rate into 1 basis point. 1 basis point. 0.01. change in price divided by change in market rate into 0.01. This is the formula you need to by heart. Change in market price divided by change in market rate. So, price divided by rate. Price divided by rate. Change in price, this one should not, this one denominator, numerator. So, the numerator is the change in price divided by market rate. Price divided by market rate. That is what you have to by heart and remember. BPV works out example 1. A 5-year 6% semi-annual bond. Market yield is 8% as a price of 92, which rises to 92.10. See, change in price is given in the question. What is the formula for BPV? Change in price divided by change in market rate. So, change in price is given, change in market rate is also given. A 5-year 6% semi-annual bond, market yield of 8% has a price of 92, which rises to 92.10 at a yield of 7.95. So, the yield is 7.95, market yield of 8.8%. So, when the rate changes at the 0.5%, change in market rate is also given, change in yield is, price, market rate is given, change in price is given. So, both are given. You know the formula BPV, you will be asked to find out, calculate BPV. Very simple. Apply these two things in the formula. It is simple as we first need to calculate change in the market price as follows. At 8%, market yield is 92. At 7.9%, market yield is 92.10. Simple. So, change in market yield is equal to 0.5. That means 8%. 8% is the original rate, 7% is the 7.95 is the change rate. So, 0.5 is the change in market yield. 8 minus 7.95. And change in price is 0.10, that is 92, and between 92 and 92.10. The change in market price is 0.10. So, now we got the both. Change in price we got it, change in market price also we got it. For 0.5%, 0.05% change in market rate, price change is 0.10. Then calculate BPV. BPV as we know is the change in value of an investment due to 1 basis point change in market yield. Simple. So, answer therefore is BPV is equal to 0.10. What is that 0.10? Change in price. Change in price is 0.10. Price change is 0.10. Change in price divided by change in market rate. What is the market rate change? 0.05%. So, 10 divided by 0.05 into 1 basis point, 0.01. 0.10 divided by 0.05 into 0.01. 1 basis point will give you rupees 0.02. That is 2 paise for rupees 100. Face value 4. So, BPV is 2 paise. This is the way in which we calculate BPV. So many examples we can do. So, here and there so many changes, scenario changes, story changes. So, once you know the formula, it will be easy for you to calculate BCV, and what is the reason, what is the rationale behind calculation of this BCV also you have to find out to assess the change in value of an investment due to 1 basis point change in market yield. That is what we are finding out here. So, 1 or 2 examples we will do in the next session, and we will move on to the major topic, VAR. So, the volatility calculation starts with BPV, after that VAR.